I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. Big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly. So much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So yeah, I mean, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren, and how do I pass it on appropriately. Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this, and it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything. Gold maintains its purchasing power, and most other items across the board, from food to energy to real estate, measured in gold, it's becoming cheaper and cheaper and cheaper as things measured in dollars are becoming more and more and more and more expensive. You can pick anything you want. Automobiles, college tuition, and I have an answer for it. And that's the scary thing. I wrote one thing down to kind of show that it just kind of caught my attention. And it's just very simple. In 1978, a student working full-time summer job at the minimum wage of $2.65 an hour could earn roughly $1,378, which was more than enough to cover the average tuition and fees of $688 at a public university. So when you talk about inflation outpacing standard of living, it's extraordinary. But if you look at gold at its value, since then, since 1978, when it would have been priced at, I don't know what it was back then, a few $100s anyway. But point of it is that, look at where gold is today from where it was then. In fact, let's just look real quick just to make the point. We'll see where gold was in 1978. What was average gold price in 78? Was $193.4. So if you are earning minimum wage and you're able to make, what did they say, 1,378. So 1,378 divided by 193.4. Well, you would have bought 7 ounces of gold with your minimum wage summer job that today would be worth $26,000. So that would cover your tuition in most public schools. A lot of the highfalutin ones are going to be 3 times that, because college is probably a poor example showing how much it's outpaced itself. But point of it is that what is $1,100 worth in fiat versus in this term. I just think it's important to understand that gold and silver have done a wonderful job in the face of a dollar that is destined to continue to lose purchasing power and probably accelerate.
People often think that having big money means you've got it made, that you've got no problems. But let me tell you something. When you're sitting on that kind of wealth, it's not easy. It's actually a burden. Because where do you put it? Seriously, think about that question. If you've got $1 billion, or even 100 million, what do you do with it right now? Stocks are at all-time highs, bonds are near their highs, but losing organic demand. Real estate is ridiculously expensive. Banks are undercapitalized, and you as a depositor are just an unsecured creditor thanks to bail-in laws. That's the dilemma the big money is facing. And the thing about big money is they can't just buy quietly the way you and I might go out and buy a handful of silver coins. When they move, the ripples shake the whole market. They've got to think, and they've got to think strategically. Let's look at short-term interest rates. They've been coming down, and Trump is pushing to cut them even more, maybe by 200 basis points. That would put rates around 2%, but the official CPI is still at 3.1%. And anyone who follows John Williams at Shadow Stats knows the real inflation is closer to 11%. That means even if you're sitting in so-called safe treasuries, you're losing purchasing power every single day. It's financial suicide disguised as prudence. And look, this isn't new. Governments have been lying about inflation forever. They've changed the way CPI is calculated multiple times so that it understates reality. If they measured inflation today the way they did in the 1970s, the number would be shocking. So when they tell you inflation is under control, you've got to laugh. Under control for who? The bureaucrats? Because it sure isn't under control for the family trying to buy groceries, pay rent, or send a kid to college. Now, when you have that much money, the calculus changes. You're no longer thinking about chasing the next hot tech stock. You're thinking about preservation. You're thinking about your kids and your grandkids. You're thinking about how to hand it down without watching it evaporate. Because wealth built over decades can vanish overnight when the currency itself is the problem. And let's not forget, every market right now carries massive risk. Stocks, they're propped up by speculation, options leverage, and FOMO bonds. Synthetic demand is being engineered through programs like the so-called Genius Act. I mean, you can't make this stuff up because organic demand has collapsed. Real estate, at all-time highs and totally dependent on cheap financing that may not last. Banks, over-leveraged, undercapitalized, and one black swan away from another 2008. So again, where do you go? Where does big money go when everything is fragile? That's the question they're asking every day. Now, I'll be the first to admit, I own a precious metals company. People could say, of course Andy says buy gold and silver, it's his business. And I get that. But anyone who's listened to me over the years knows I've tried to be as genuine as humanly possible. I don't say something I don't believe. I do as I say. And if people don't believe that by now, they never will. Here's the reality. The biggest money in the world is already moving into gold and silver. They don't announce it on CNBC. They don't take out ads in the Wall Street Journal. They do it quietly in the cover of darkness. Meanwhile, the talking heads like Jim Cramer call it speculative or frothy. They miss the forest for the trees, but the actions of central banks, sovereign wealth funds, and billionaires are crystal clear. They're treating gold and silver not just as an emergency lifeboat, but also as an opportunity. Because metals don't just preserve wealth. In times like this, they multiply it. Gold is up over 40% this year. The dollar is down 11%. That's not a coincidence. That's cause and effect. And this isn't just about emergencies. It's about dry powder. Holding metals gives you liquidity in real terms. You're protecting purchasing power while waiting for other assets, stocks, real estate, whatever, to reset. When they do, you'll be in a position to buy them cheap. Take the example of tuition. In 1978, minimum wage was $2.65. A student working full-time over the summer could earn about $1,300 to $78. That was enough to cover average public university tuition, which was about $688. Think about that. One summer's work could pay your tuition in cash. Today, forget it. Students graduate buried under debt.
Well, I mean, it's physical demand coming into the COMEX, coming out of London, coming out of Switzerland. The demand is off the charts. The lease rate in London, which is typically 0.5%, rarely gets above 1 or 1.5%, even in times of stress, and then it would typically only be for a short period of time. The lease rate is the rate at which it would cost to borrow bars to short or to cover a position, is as high as between 5 and 6.5%. And that's an anomaly, to say the least. It signals great tightness inside of the market at the highest of levels. The amount of silver that's coming into the COMEX is off the charts. From a technical formation, you have a 45-year cup and handle that might be as powerful of a formation as you will ever find in technical analysis, especially one that is mature as silver. 45 years, and the way that it works is the beginning of the cup would have been 1980 at $50, and then it goes down to the bottom, the shape of like a bowl or a cup, to $4 or thereabouts in the early 90s, and starts to come back up to 2011, almost to the top of the cup. Doesn't preach it, comes down in consolidation for the handle, and here we are at basically $44, very close to moving back up. Now, the way that works is once you breach that level, the top of the lip of the cup, the $50 level, first of all, there is no resistance at all. But the way technical charting would work is that you take the difference between the top of the cup and the bottom, which is approximately from 50 to 4, about $46. You would add it onto the top, and your next target upside would be $96, 96 to $100. Is that crazy? No, it's not. I mean, triple-digit silver is something one could expect at some point. And then when you realize that the government reclassified silver now as a critical element, a critical mineral, they've put a floor under the price of silver. And so I think, all of the talk over the last 6-7 months, and I said no from the get-go, this is not about tariffs, never was. It was a ruse to bring it all back. This is reshoring. This is understanding that the biggest money in the world understands the significance of things like silver. The biggest traders here in the United States, the institutional traders, when they start to pay attention, when they start to accumulate, we should all pay attention. We've been talking about this on a central bank level for a few years now, about the deliveries into COMEX for a few years now, about the accumulation by India, by Russia, by Saudi Arabia, by China. China flying around the world and buying doré when they're the second largest producer in the world, sending it back to China for refining. Why would the second largest producer of silver in the world find it necessary to fly to Latin America to buy concentrate and doré directly from a miner, pay double what the West will, ship it back for refining if it were just this, this rock that hasn't done anything forever? And I don't know, silver right now feels to me like gold did about a year ago when it was right in the $2,100, $2,200 range, and it kept trying to break out and would, consolidate and try to break out, come down, consolidate, in a long period of consolidation, and then broke through, and it hasn't looked back. I would say that's about where silver is right now. I look at it as the most undervalued asset in the world, and now evidently the United States finds it significant enough to call it critical.
So let's push deeper, because everything we're talking about isn't just about numbers on a screen. It's about the structure of the entire financial system. And right now, that structure is cracking. Start with the bond market. For decades, treasuries were the safest asset in the world. Everyone wanted them. Central banks hoarded them. Pension funds bought them. Individuals piled in. That demand kept rates low and allowed Washington to borrow endlessly. But that era is over. Foreign central banks aren't buying treasuries anymore. They're selling them. China has been dumping treasuries for years while adding to its gold reserves every single month. Russia sold nearly all its treasuries and moved into gold. Even allies like Japan are trimming holdings. Why? Because they see what's happening. They see a US government addicted to debt, a Fed that's political, and a dollar whose purchasing power is evaporating. So when organic demand dries up, Washington invents synthetic demand. They pass acts with clever names. They create vehicles to funnel money into treasuries. They pressure banks to step up. But it's a shell game. It's not sustainable. Meanwhile, the deficits are staggering. We're running $2 trillion shortfalls as far as the eye can see. Interest on the debt is the fastest growing line item in the federal budget. Within a few years, interest alone will exceed Social Security, Medicare, or defense. Think about that. We'll be borrowing money just to pay interest on the money we already borrowed. That's a death spiral. And as rates come down on the short end, long-term yields rise. Because the bond market knows. The bond market understands inflation risk even if the Fed pretends not to. So if Trump gets his way and slashes rates by 200 basis points, the yield curve will steepen violently. Inflation will accelerate, the dollar will weaken further, and gold and silver will explode. Now let's add geopolitics. The BRICS nations are not just talking anymore. They're building an alternative financial architecture. They're trading in local currencies, creating cross-border payment systems, and quietly stockpiling gold. Some analysts think we'll see a BRICS trade settlement system backed by gold within the next 5 years. And here's the thing. It doesn't have to replace the dollar outright. It just has to provide an alternative. Every trade settled in gold is one trade not settled in dollars. And over time, that chips away at dollar demand. You don't need a tidal wave to sink a boat. A steady leak will do it. Think about this. In 2000, foreign central banks held 73% of their reserves in dollars. Today, it's closer to 55% and trending down every year. Gold reserves, meanwhile, are trending up. That's not a coincidence. It's a global vote of no confidence in U.S. fiscal and monetary policy. And the public? They're always the last to figure it out. Retail investors mocked gold buyers in 2015 when it was under $1,200. They mocked silver stackers in 2019 when it was $15. But by the time silver breaks $50, those same people will be calling dealers begging for coins. That's how it always works. The insiders buy when no one's paying attention, and the public piles in at the top. That's why I keep stressing, don't wait for CNBC to give you permission. Don't wait for Jim Cramer to shout, "Buy gold," into the camera. By then it'll be triple the price. And look, no disrespect, but Cramer calling gold too speculative is like a pyromaniac calling a candle dangerous. The man has pumped every bubble of the last 20 years, and every time gold is about to break out, he dismisses it. That alone should be a contrarian buy signal. Let's pull back for some history, because it always rhymes. In the 1970s, we had stagflation. Rising prices, weak growth, political chaos. Gold went from $35 to $850. Silver went from $1.30 to $50. That's almost a 40 times move in silver. And the fundamentals today are worse. The debt is larger, the deficits are bigger, the entitlement obligations are unfunded, and the political divisions make the 1970s look like a picnic. Or take 1933. The US government literally confiscated gold from its citizens, then revalued it from $20 to $35 an ounce. That was a 75% overnight devaluation of the dollar. Anyone who had gold outside the system preserved their wealth. Everyone else got fleeced. Do you think they couldn't pull a trick like that again in a crisis? If anything, it's easier now. That's why I always say, hold some metal in your own possession. Or look at Weimar Germany. As the mark collapsed, Gold and silver weren't just stores of value, they were lifelines. 1 ounce of gold could buy an entire block of apartments. Silver bought food when the paper currency wouldn't buy kindling. No, I'm not saying America will go Weimar next year, but the underlying ingredients, runaway debt, political dysfunction, money printing, they're all in the recipe. Now let's zoom back into today's numbers because they're staggering. Year to date, gold is up over 40%, silver is up nearly 50%, miners are up over 110%. Compare that to the S&P 500, up 13%. And yet the media says nothing. They trumpet Nvidia hitting a new high, but ignore Newmont being the best performing stock in the entire S&P. They scream about Bitcoin ETFs, but won't mention gold ETFs seeing record inflows. Speaking of Bitcoin, let me make this point clear. For years, we were told Bitcoin was digital gold, gold 2.0, better than the real thing. Yet priced in gold, Bitcoin is down 15% over 4 years. How is that an inflation hedge? How is that a store of value? Gold is up, silver is up, miners are soaring, Bitcoin is lagging. And when people start rotating out of Bitcoin ETFs into gold ETFs or into miners that actually pay dividends, that flow will accelerate. Now here's something I want you to really think about. Gold and silver are not just about price appreciation, they're about truth. Fiat currency is a lie. It promises stability, but guarantees devaluation. Gold and silver tell the truth. They measure purchasing power honestly. That's why governments hate them. That's why central banks suppress them in paper markets while simultaneously buying them hand over fist in physical markets. They hate what metals reveal, but they can't live without them. And that's why I call metals not just lifeboats, but opportunities. They give you freedom, they give you liquidity, they give you the ability to protect your family in a storm, and then deploy capital when assets are cheap again. They're not relics, they're not barbarous, they're essential. So where do we go from here? I believe we're at the beginning of the biggest transfer of wealth any of us will ever see. As fiat currency loses credibility, everything priced in dollars will reset. Stocks, bonds, real estate, all of it. The people holding metals will be on the right side of that reset. The people holding paper will be on the wrong side. So my advice is simple. Don't wait. Don't second guess. Don't overcomplicate it. Buy gold, buy silver, hold them outside the system. Protect yourself, your kids, your grandkids, because when the dust settles, you'll be glad you did. And you'll be in a position not just to survive, but to thrive.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.